In this video, you'll learn about the income statement, what it is, the key things it will teach you about a business, and what I look for when reading one. The income statement reports how much money a business made or lost during a period of time, such as a quarter or a year. To put it simply, profits equal revenues minus costs. At the top, we have revenue, also called sales. This is called the top line. As we go down the income statement, we subtract various costs. This leaves us with profit, or net income, at the bottom. This is called the bottom line. Here is Chipotle's income statement. It covered a one-year period from the 31st of December 2022 to the 31st of December 2023. One income statement doesn't tell you much about a business. To gather more insight, you should look at several income statements over time, such as the last 10 years. Websites such as ROIC.ai will save you time. So what should you look for? I look at these 5 key metrics: growth, margins, operating leverage, interest coverage, and share dilution. I like to invest in companies that are growing. Even a company growing at 5% a year can be a great investment. If we look at Chipotle, we can see revenue grew from $3.2 billion in 2013 to $9.9 billion in 2023. That's a 10-year compounded annual growth rate of 11.9%. I like companies that are maintaining or growing their margins. Take gross margin, for example. Gross margin equals gross profit divided by revenues. A business will usually buy raw materials from suppliers and sell finished products to customers. The lower the price of the raw materials and the higher the price of the finished products, the higher the gross margin. A business can maintain or even grow its gross margin if it has bargaining power with suppliers or pricing power with customers, or both. Looking at Chipotle, we can see gross margin was 27% in 2013. It declined to a low of 13% in 2016, but has recovered back to 26% in 2023. For every $100 in revenue, Chipotle spends $74 to generate that revenue, leaving $26 in gross profit. Chipotle's ability to revive its gross margin indicates bargaining power or pricing power. Operating leverage is when profits grow faster than revenues. That means if revenues grow by $1, profits grow by more than $1. This will happen when a large portion of a company's costs are fixed. We can categorize costs into 2 types: variable and fixed. Fixed costs remain constant no matter how many sales you make. Variable costs, on the other hand, will increase as sales increase. Say you own a cafe. Coffee beans are a variable cost. If you sell 100 coffees, you might need 5 bags of beans. So if you sell 1,000 coffees, you'll need 50 bags. As you sell more coffees, the amount you spend on beans increases. Rent, on the other hand, is a fixed cost. It doesn't matter if you sell 100 coffees or 1,000. Your rent remains the same. The greater your percentage of costs that are fixed, the higher your operating leverage. Once you make enough in sales to cover your fixed costs, the difference between your revenue and total costs will grow, meaning greater profits. Unfortunately, this works in reverse too. If you have a high portion of fixed costs, i.e. high operating leverage, a decrease in your sales will mean a greater decrease in profits. A company may not break down their fixed and variable costs for you, but to identify a company with operating leverage, look for operating income that is growing at a faster rate than revenues. Take Chipotle, for example. From 2022 to 2023, revenue grew by 14.3%. Operating income, on the other hand, grew by 34.8%. From this we can see Chipotle has operating leverage. The income statement can help us determine if a company can comfortably pay the interest on its debt. That's important because if a business can't pay its interest, it may be in financial trouble. To calculate the interest coverage ratio, we divide the earnings before interest and tax, EBIT, also known as operating income, by the interest expense. In 2023, Chipotle made $1.6 billion in operating income and had $0 in interest expenses. Chipotle has no interest to cover. If I'm going to be a shareholder in a company, I don't want my ownership to be diluted. My ownership will be diluted if the company is issuing too many new shares. Here we can see Chipotle had average shares of 1.6 billion in 2013 and 1.4 billion in 2023. Chipotle's shares outstanding has decreased by around 200 million or 12.5% over the past 10 years. Shareholders have not been diluted. To summarize, I look at the following 5 key metrics when analyzing an income statement: growth, margins, operating leverage, interest coverage, and share dilution. By looking at these metrics, you can get a better understanding if the company is likely to grow its profits and cash flows in the future, meet its financial obligations, and if you as an investor are likely to see a greater share of those profits. For more videos on investing, follow Value Theory or go to valueinvestoracademy.com.